Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Thursday, September 11th. Wall Street got off to a sharply lower start on Thursday, led by more trouble from the financials. The sticking points continue to be Lehman Brothers, which is 40% lower in early action, the specter of further capital raises in the financial sector, and growing concerns about the continued slowing of foreign economies. The lack of follow-through from the Fannie Mae and Freddie Mac takeover rally on Monday and no convincing sector leadership to speak of are added impediments weighing on sentiment. Separately, evidence of a flight to safety trade, which was reflected in the buying of the U.S. dollar and U.S. Treasuries, has influenced many equity buyers to stick to the sidelines. The initial claims report for the week ended September 6 isn't likely to change that thinking. Claims for the week ended September 6 declined 6,000 to 445,000. That was slightly above the 440,000 consensus estimate and a small consolation to the market, which recognizes that continuing claims rose to 3.525 million from 3.403 million. The 4-week moving average for claims held steady at 440,000. It is encouraging to see that there hasn't been any further deterioration in the claims trend, yet it is still at elevated levels that suggest we'll see non-farm payrolls decline for a 9th consecutive month in September. This report is not overtly bad, but it is not particularly good either, as it reflects a softening labor market. The July trade balance data showed a slight increase in the real trade deficit from June, but the outlook is still for net exports to be a strong positive contributor to third quarter real GDP. The July real trade deficit, which is price adjusted, was $41.2 billion. The average trade deficit for the second quarter was $43.9 billion. That was down from $49.5 billion in the first quarter. That $6.4 billion drop in the second quarter led a 3.1% positive contribution from net exports to second quarter real GDP. Now the third quarter is starting off $2.8 billion below the second quarter average. If it is flat the next 2 months, net exports will add about 1.5% to the third quarter real GDP number. This alone could push the GDP change above current market expectations of a 1.3% increase. The stronger dollar will, over time, end the sharp declines in the real trade balance seen this year, but that takes a while. The July data show a surprising jump in imports that we expect to be temporary, and a smaller real trade deficit is likely for August. The trade data this morning are positive from a GDP standpoint, but probably won't have much impact. I'm Pat O'Hare for Briefing.com. Thanks for listening.